Right, let's continue on. Last chapter, lifetime financial provision. So, a greater proportion of our focus is on the corporate side of managing the wealth and investment. But ultimately, of course, we are advising clients. But if we were looking at the likes of estate planning, inheritance, and otherwise, insurance, protection instruments, essentially, then our focus needs to recalibrate across as well, right? So medical advances, we recognize, have increased the lifespan of individuals. And ultimately, if that is the case, retirement planning is going to play a much important role as well, because you can only be working for so long. And eventually you do need an income to supplement your cost of living, right? And if you want to have a annuity, for example, to meet your cost of living and your standard of living, you need to be able to put down a lump sum at the end of your retirement so that it can generate that income for you. But to make that lump sum across your working life, let's say 30 years or 40 years, whatever it might be, you need to work towards accumulating that lump sum at the end of your working career. You got the lump sum going and annuity coming to you. Now you've got the retirement plan in place, for example, right? So understandably, the intended retirement age is going to play an important role. The salary, the savings, the other incomes, all of these are going to play an important aspect in this decision in relation to retirement plan. Governments in particular focus on allowing for tax benefits when it comes for retirement planning. Because ultimately the burden does not fall on the government if that is the case. If you know, even on an individual basis you're having a pension plan, it is encouraged to do so by the governments with tax advantages coming to you, because ultimately it's a less of a burden on the government as well. So the advisors, for example, will need to determine the details of any schemes that the client is already part of as well. They will be able to establish what are the benefits coming from the likes of an EPF or a defined benefit plan or a defined contribution plan. At what age can you retire? From the ongoing income, we are trying to figure out whether it's enough for their standard of living, etc. We looked at the different types of pension products out there as well. Occupational pension schemes, the employer sets up the scheme, right? This is essentially part of the employee's remunerations and benefit package as well. The employer contributes the overall cost, providing a significant benefit to the employee. Schemes usually benefit from tax efficient treatment or tax attractive tax treatment, and it provides an efficient vehicle for meeting the retirement needs of an individual, right? Although that can be questionable in a Sri Lankan context, but let's not even go there, right? Occupational pension schemes like the EPF, for example, right? And we define this a lot more further. We went on to look at a defined benefit scheme under the occupational scheme, also known as a final salary scheme. Be wary of these alternative names and recognition criteria as well, because it can have a bearing on your exam. The pension received here, the defined benefit scheme, is in relation to the number of years of service and the individual's final salary. How long have you been with the organization? What was your final salary? These are going to have a bearing on what is going to be your benefit in retirement, right? Essentially, what are we promising? Essentially, a defined benefit scheme is promising a benefit. It is promising a given level of income at retirement. Usually, it will be expressed as a proportion of your final earnings. Contributions are made by the employer and by the employee. It can vary from scheme to scheme. You know, in our context, 12%, 8%, whatever it is along the lines. But both will be contributing here. And ultimately, in retirement, you are promised a particular benefit. 100,000 rupees a month or 50,000 rupees a month or whatever it is. you're promised a particular benefit, right? So this is beneficial for the employee in the context that, in retirement, what is going to be coming to you. And you can plan for it, your standard of living, your expected investments, your other pension investments which you might want to make, etc. You can plan for it because you know what the benefit is at retirement. Right? There is some level of certainty and visibility around it. Then comes the defined contribution schemes. This is from the employer's perspective, is a little more favorable. Why? The employer is promising to make a contribution every month until your retirement. That's it. No benefit at retirement, which will be 40 years down the line or 35 years down the line. Nothing of the sort. Until your retirement, I'm going to make a specific contribution every month. That's it. Right? Now, one of the main, among the main differences here between the benefit and the contribution is, for a benefit, defined benefit scheme, the employer has to figure out what is the mortality rates, how long will he be with the company, what is his final salary, what are the chances this guy can get promoted, what is the probability, in what level will he be when he is retiring. All those need to be factored in, and then you need to work around, okay, what is the liability in terms of the benefit at retirement? If that is the case, what is the lump sum necessary in 35 years time? What is that in today's terms? Major context. Defined benefit scheme. Defined contribution scheme. This month, I need to park $500 for this guy. Done and dusted. Right? When it comes to defined contribution scheme, therefore, much better for the employer. He makes the contribution, his obligation is done, and the investment risk and decisions will lie with the employer. Whereas with the defined benefit, the investment risk also lies with the employer himself, right? Disadvantage, of course, for the employees, the income the employee will receive in retirement will not be known in advance, right? Which makes obviously the planning aspect of it a lot more difficult. But particularly who contributes, what is being promised, who bears the investment risk, those in particular have important bearing on the decisions here. Right? We also looked at personal pension plans as well, where individuals themselves will undertake certain pension plans, and out of their salaries, they will park certain monies for these personal pension plans. It gives them the flexibility. They can choose the options and the alternatives which are there. Major benefit for the employee. So some of the stages, the key stages in this whole process is, we have to go through that retirement. What is the aspirations? What is his current position? What is the capital necessary therefore? This is the exact thing which I told you when it came to the defined benefit scheme, right? What is the capital that is necessary to make sure that benefit is being provided? How much of income that we need to give in retirement? What is the intended lifestyle? Is there any existing retirement plans? All these questions we need to ask. Because if he already has a pension plan, for example, let's say a corporate pension plan, for example, and if that is meeting 75% of his objective, the personal pension plan which we are advising, we don't have to take a massive risk to fill that gap, right? Versus he has a corporate plan which is only contributing to 15% of his requirement, hypothetically. Now, to fill the rest of the 85%, either the quantum has to increase, or the period has to increase, or the risk has to increase, or his requirement has to come down. These he need to manage, and to manage that we need all of this information, right? From the current financial position to his aspiration requirements, we looked at a questionnaire of the sort. We looked at an illustration. This calculation can be a popular one. We will look at in the question as well. Client has a requirement in retirement of $50,000 per annum. He already has a pension plan which will eventually generate 30,000 per year. He also has a personal plan which generates another 5,000. So essentially the deficit that we are trying to fund is $15,000. Right? To earn $15,000 in retirement as an annuity, when we are given a 6% interest rate, for example, we need $250,000 to invest in today's terms. But this gentleman is only going to be retiring in 25 years' time. And current inflation is 4%. So what is the value of $250,000 today in 25 years' times at a 4% inflation? That is 667,500. That's the value which I need to build up the base so that when I invest it at 6%, it actually generates 40,500. But hey, the deficit was only 15,000, but it's 15,000 in today's terms. 15,000 in 25 years terms is actually 40,500. This illustration makes sure that you are extremely familiar with. Other sources of capital and income in retirement are going to be important because we are ultimately searching for that deficit value. We don't want to take any excessive risk or otherwise. We need to look at, assess his existing pension plans. When it comes to presenting the recommendations, the same structured approach that we looked at previously in a lot more detail, we will park it here as well. What are your needs and wants? What are your goals? What are the existing arrangements? Do you have any restrictions? Do you have any constraints? What is the level of income required? As a result, what is the capital requirement? Is there any additional protection which you need to think about? And then we make the recommendations, right? And different information necessary for the protection planning along the likes of dependence, health, assets, liability, lifestyle, etc. will all play a role. Where does protection, now we are talking about insurance, where in particular will protection come into play? Either your life and your family, to maintain your lifestyle and income. Is it in relation to your home or is it in relation to your business? So you can have the likes of life cover, critical illness, medical covers, long-term care. We need to be able to distinguish another area where I mentioned to go through the curriculum. Income protection, household cover, mortgage insurance. If you're talking about business key person insurance, shareholder protection, partnership protections, all can be part of the protection that we are after. Right? And we also looked at, when it comes to assessing the priorities, how can we go about it as well? We looked at a basis there. Again, more time to spend with the curriculum there as well. We looked at the prioritization process, where areas that you need to deal with in relation to protection, quantifying the impact and likelihood, etc. We spent time in terms of dissecting that. We broke down an individual income statement, so to speak, on the income and expenses, which will help us with establishing those information. What are your existing protection arrangements? We are basically following through that procedure which we discussed. Life assurance. Now there is a life assurance and there is general insurance. We need to be able to distinguish between the two. We looked at the different parties to life assurance and what are the implications there, right? Profit, whole profit, not for profit, etc. All of these principles we touch based on. Term assurance, another area which you can see questions coming on. Type of policy that pays a lump sum in the event of death occurring within a specified period, and this can vary for many purposes. We distinguish between a level cover, an increasing cover, and a decreasing cover. Level cover, the amount, the lump sum remains same, and the premiums also remain the same. Increasing cover, the amount of the cover and the premium will increase. If an event happens, the lump sum becomes much larger. Decreasing cover, original amount actually comes down, but the premium remains the same. So technically, that is the most expensive one, decreasing cover. Why? Your cover is coming down, but your cost is remaining the same, right? So technically, the percentage of your cost to cover ratio, cost to protection, is actually increasing over the period of time. Right? We distinguish between the different protection types, the critical illness, accident and sickness, medical insurance, long-term protection, business insurance, key person protection, shareholder and partnership protection, etc. We looked at all of this in detail as well. And you can expect questions. For example, they'll put you into a particular situation and ask you which is the most appropriate type of protection here. how to select the protection products and the product providers, their financial strength we discussed is an important aspect, because you take a life cover for the next 20 years, and in 17 years time, when you are going to claim the respective, or when your dependents are going to claim the insurance, and if the insurance company is no longer there, then we have a major problem. Quality of service is important. Recommendations as the advisor, we need to be able to meet their requirement. It should be consistent with the attitude. Suitability, again, from a tax perspective, we need to be able to identify, is it most efficient or not? Given their level of income, is it affordable to them? Major considerations, right? We looked at the key features document and information, assessing we looked at estate planning, trusts and foundation next. Estate planning is particularly important because when it comes to the continuity of your estate, right? If you're going to write it to someone, but think of a local context, the whole stamp duty and whatnot can actually play a major role there in determining the cost there, right? So we need to have to play a role here in terms of determining the most tax efficient way of doing that. We looked at this will, execution, inheritance, etc. So if you put a will down, and after you will have an executor who will execute the will. Pretty straightforward. But if you pass away without a will, then it is considered that the estate is intestate, right? Then you have a whole process of having to go to courts, where the courts themselves can end up deciding how it is going to be distributed, right? Intestacy rules will decide how the inheritance is going to work. We looked at life assurance in estate planning as well. If you are going to simply pass on funds to the next generation, there can be significant tax implications. And as a result, one way of passing on the funds a lot more tax efficiently is to actually take life insurance. You will pay the premiums across a period of time, and when the event occurs, that entire lump sum is going to come to the respective beneficiaries, right? So there are interesting considerations there as well. We also looked at how trusts play a role when it comes to inheritance also. A legal vehicle into which assets are transferred and managed by a trustee who have the responsibility to apply the assets for the benefit of the named beneficiaries. You have the settler, you have the trustee, you have the beneficiaries. We identified between the users and the characteristics of trust, the different types of trusts which are in there, which you will have to distinguish. We identified absolute trust, charitable trust, trust for the disabled kid, for example. All of these elements which we looked at. In particular, we also focused on offshore trusts. Right? So these are like, the whole Panama Papers, and what was it most recently, there was other issues which came across, Pandora's box or whatever. Privacy, protection, and inheritance, tax efficiencies, flexibilities, access to even professional investment funds, etc. All of these elements are going to be some of the benefits that will be offered from an offshore trusts and foundations as well. We distinguish between foundations, their uses for private and charitable purposes also. Right, which basically brought us to the end of our discussion on summary on lifetime financial provisioning. Let's jump into our questions. Right, questions on lifetime financial provisioning. Question number 1. Right, we just finished off with trusts, so maybe you remember what's going on here. Which of the following is actually an easy question? Which of the following is not a reason for establishing an offshore trust? The question is asking you which is not a reason, right? Everything else is going to be efficiency. Yes, you may have access to, for example, professional funds, tax efficiencies, etc. Financial security, yes. I mean, that's why we were talking about it under estate planning, because it helps us to more efficiently pass it on to the next of kin. Protection, yes, it is a protection instrument. Publicity, I mean, most definitely that is not. It is the privacy of it that is a benefit for us. So definitely publicity is not one of the variables which is affecting that decision. Right now, these are the questions that you, a couple of calculations I told you which you need to be aware of. You calculate that your client will need to generate an income of 25,000 to meet their retirement needs. So don't forget, the situation is, this is the point of time today, but you're not retiring today. You are ultimately going to be retiring at a point of time in the future, right? And they need $25,000 to meet their retirement needs. If they earn 5% per annum now, don't forget with financial questions, always extract the information. $25,000 is the necessity, right? And if they can earn at 5% per annum, so we know this is essentially going to decide what is going to be my annuity. Right? How much of a lump sum will be needed in 20 years time? Right now we are told the period, right? 20 years time. That is this period over here. If inflation is expected to be 4%, right? Now we need to figure out what information to use there. Why do we need the inflation? Inflation is, we will calculate the lump sum necessary to generate the income. But that will be in present value terms, today's terms. We will have to identify what is this value going to be in future value terms. To do that, what we are going to use is inflation. Right? To calculate the annuity value, meaning the lump sum necessary, we will be using the interest rate that is applicable. Right? Very important that we be able to justify that. Right? So let's put the answer down itself. Number one is, we are told he wants $25,000 per annum in retirement. This is essentially the annuity. To calculate the annuity, as I mentioned, what you're going to want is this interest rate. Divide it by 0.5. It will give you a value of 500 million. But this value, don't 500,000. This value that we have calculated is this lump sum is in present value terms. If I were, now I'm not going to save today to earn 25,000. I want to save it in 20 years time. So if present value terms, the cash flow is worth 500,000, can I not calculate the future value term if I'm also given inflation? Absolutely doable. How do I do that? Future value equals present value into 1 plus r to the power n. That is my calculation, right? So you have the present value of $500,000 into 1 plus r is the inflation, which is 4%, to the power 20 years, which gives me a value of 1,095,562. What is this answer here? And this is the lump sum I need to invest at this point of time, which is going to give me the respective annuity. Don't forget, this 25,000 again is in present value terms. The value which I calculate here, which will probably be more, let's say for example, it should be $40,000. And if I bring it to present value terms using this formula over here, the value will be $25,000. Make sure you are familiar with that calculation. It could be a popular area in the exam. Your client, question number 3, is worried about the financial implications of growing old and the costs. See how to pick the keywords. Now immediately, growing old and the cost, right? Long term care should have been screaming at you here, right? Fundamentally, your client is worried about the financial implication of growing old and the cost that will be incurred. Which of the following protection products should be considered? This is the example I told you. You will be given a situation and also select the protection product. Critical illness, we are not mentioning anything of the sort. Decreasing term assurance, not relevant. Income protection, that is not what we are after. Long-term care is the answer that we are after. Look for the keywords, put it into context. The answers are going to be a lot more visible. Question 4. Tricky question. Which of the following would not be considered in setting the premium of a life assurance policy for an applicant? Age is most definitely a consideration. If you're 50 and you're going to take a life assurance cover, that's going to be an important variable. Occupation, if you're an accountant versus when you're working in a timber factory where there is this huge saws or whatever, is most definitely going to have an implication on the premium. Right? These are the obvious ones that are correct. We are looking for the ones which is incorrect. Gender or nationality. Gender also has an implication. For example, lifespan. Females may have a higher lifespan than males. Does it have a bearing on the assurance? Of course. Nationality. You being Sri Lankan versus you being European doesn't have a direct bearing, doesn't it? Nationality is not the main one of the considerations that we will take into context when we are talking about life assurance. Which of the following is true? Asks question number 5 of income protection. Income protection. Now, this is where I told you, you need to spend a little more time with the curriculum to fine tune these elements and get some familiarity there, right? Payment will cease on return to work. Provides regular income immediately. Available to those aged 18 to 75. Premiums are relatively inexpensive. Again, if you spend time with the curriculum, you will recognize income is not made available immediately. There is a waiting period. Not 18 to 75, this is much smaller, right? Premiums are going to be expensive, not cheap. And generally, of course, when you return to work, it is going to cease. Designed to pay out an income or benefit when the person is unable to work. Premiums are relatively expensive. Policy runs for a set term. There's a waiting period. Payment will cease on return to work. Available to those 18 to 59. I said 69. Ends before the 65th birthday. Premiums are lower, longer the deferred period. Right. So our answer here is A. Question number 6. Which of the following will involve the purchase of an annuity on retirement? Personal pension plan, money purchased, defined contribution, or defined benefit? This was an interesting question. As you can see, the answer is going to be B, because the personal pension and defined contribution, both of these are examples of where the employee has to take the investment risk. And both of these are example of money purchased schemes as well. Here, only the money is coming into the account, or you are going to put if it is a defined contribution, money is going to come into the account. If it is a personal pension, out of your salary, you're going to park separate amount of monies into your personal pension scheme. Ultimately, both of these will have to result in you purchasing an annuity. Personal pension, defined contribution are both recognized as money purchase. So personal pension, yes. Money purchased, yes. Defined contribution, yes. Defined benefit, no. So the answer is B, 1, 2, and 3. So essentially, personal pension and defined contribution are both types of money purchased contribution schemes, right? Which will end up with you having to purchase an annuity. Which of the following is not covered by general insurance? I would think another easy question. Let's go back to front. Property is general. Marine, general. Motor, general. Life is not general. Life is life insurance, right? Obviously. Question 8. An investor nears retirement age. Very important point. Nearing retirement age, right? So your requirements, your constraints, your liquidities, your objectives, your asset classes are all going to change. Their portfolio should rebalance in favor of derivatives, high risk, shares, high risk, fixed income, current income, looks good. Warrants, not relevant here. It needs to be in skewed towards the fixed income. The income requirement is going to go up, right? Your answer would be C. A defined benefit scheme, the moment you hear this defined benefit, defined contribution, highlight. Recall it to your memory. Defined benefit. You will have the benefit at retirement. Not that contribution is going to come in every month. Benefit meaning you don't have to worry about the selection of the asset class. That investment risk is going to be borne by the employer, right? A defined benefit scheme will pay a pension based on the success of the stock market. No, we didn't talk anything of the sort in today's recap. Employees' final salary, state a minimum pension, or success of a unit link scheme. Again, if you were paying attention to today's recap, you would know final salary and years of work we recognize is going to be direct contributors to deciding what your benefit is going to be in retirement. Question number 10. If a person dies intestate, which of the following is true? We touched based on this, right? Intestacy rules will determine who is going to be inheriting the property. I would have thought a straightforward question, right? Which of the following is an advantage of a personal pension plan, right? Now again, immediately recall, personal pension plan, out of your salary, you are going to put money on a monthly basis into a pension plan of your choice. Reduced administration, reduced cost, choice of fund, or reduced risk. Remember the flexibility in choosing the fund. Choice of fund was one factor which we spoke about in the recaps as well. You can choose whether you want to go to a high risk one, a fixed income arbitrage strategy, or a equity neutral strategy fund, whatever it is, you can choose where you're going to put your money. Question number 12. Which of the following is most likely to pay a lump sum benefit? Income protection, critical illness cover, mortgage protection cover, or long-term care cover. Again, if you are familiar with the products, you would have been able to easily recognize. I mean, income protection is a regular one, not a lump sum, right? Mortgage payment is also understandable. You can recognize it's going to be over a period of time. Long-term care, we recognize in our previous question as well, cost which will move as you move into retirement. Critical illness cover, on the other hand, when the illness materializes, you get a lump sum. These are not unfamiliar instruments even in a local context, which hopefully you are familiar with. What is the main objective of investing in a pension? See, you can see the questions, right? Sometimes it looks like, hey, these are not in the curriculum. Are these in the curriculum? That's what the feeling you get, but it's all from the curriculum. The application of general knowledge questions sometimes can shake things up a bit, which you need to be prepared for, right? They can ask you about a Chinese trust. They can ask you about commodities or whatever. Those are the challenging ones sometimes, right? Main objective of investing in a pension: maximize investment potential, tax relief, Saving for retirement or succession planning, easy question across over here. You're with a pension plan, you're obviously trying to save for retirement. Which of the following is false of medical insurance? As you can see, why I have put these questions is to give you a bit of a heads up. These are types of questions that can come your way. So familiarize yourself with the curriculum, the products, the etc. Right? Medical costs are covered. We are looking for what is false. Hospital costs are covered. No limit for what is paid out. Exclusions are likely to apply. We know that the medical costs can be covered, that the hospital costs can be covered, as well as we probably very well know, unfortunately, that exclusions also will apply. Is there no limit on what is paid out? Absolutely no. There are certain limits which will be put down on an annual basis, for example. Question 15. In the event a key person policy pays out, who will receive the proceeds of the fund? I remember you were talking about protection for business and a key person. If the key person policy pays out for whatever reason, who receives the proceeds? The dependents of the key person? No, we are talking business insurance. The company the key person worked for? The shareholders of the company the key person worked for? Or the employees of the company the key person worked for? So the obvious ones out are these two, I would think. It's definitely not going to the employees. It's not going to the dependents, because the business took out an insurance against the key person, and it's not going to the shareholders either, right? That doesn't make sense as well. It is going to go to the company which the key person worked for. So answer is going to be B. Right, which brings us to the end of our discussions, right? So as I keep mentioning, what is required for your exam for you to be successful is you must have spent enough time with the theory, focusing on the academics, focusing on the application. And we also had an ulterior motive, even from a practical basis. We were trying to build our competencies as well over the first 5 months, right? You also need to spend time with the curriculum, which will address all of those elements: content, thinking, application. All those elements will get addressed across. Then we moved across into the revision, quick recaps, again focusing on those critical elements, and also looking at from an exam perspective, what are the different types of questions, what should be your thinking process, keywords, etc. These were the elements which were addressed here. And finally, one last go, which you need to make sure that you're 100% for exam. Spend time with the curriculum and slides. That's a given. And of course, right now you've got to put all of this into practice in your question banks as much as possible. And as you do the questions, when you find areas that are difficult, that you're weak in, or whatever it might be, go back to the curriculum, go back to the slides. If it's like really challenging, then go back to the videos, right? Because that's time consuming, right? Go back to the slides, curriculum, etc. Iron everything out. It's 8 chapters, right? We did 8 chapters of revision across, 4 2-hour sessions, right? Make sure you're 100% before you go to exam in this entire process. Practice is going to play a very important role to make sure that you are familiar with the questions and that you are competent enough to tackle the exam in the given time. Any questions, guys, before we call it a day? Right, so it's been an interesting session for me. You guys were a bit quiet as well, though, but nevertheless, I think managing work and the course at the same time. But hopefully the objective of also bringing in that practical aspect to the financial planning element on a real life basis also was useful as well. Feel free to reach out. Would love to connect on LinkedIn. Please do connect. And if we do ever catch up, you see me somewhere, because I've hardly seen you guys. Feel free to reach out and say hello. I would absolutely love that. Yeah. So if you do have any questions here on end, always feel free to reach out. You can reach out to the coordinators or otherwise. We'll be glad to help you guys.
Usama, one
Yes.
more question. Next week, the mock exams are on, is it?
I am not sure on the timetable there, but do you have any concerns there? I can communicate it to the administrators.
Yeah, I think most of us are not ready for next week because so if you can push it at least by a week, that will be better.
I will ask them to kind of have a chat with the intermediary with HR, I think, right? Is the intermediary. So that, because look, end of the day, there's no point in you guys rushing the mock exam and the exam and it not helping you at the end of the day. So I will pass the message on someone and I'll ask them to get in touch. Yeah.
Thank you.
You're welcome. Right. So it's been a pleasure. Feel free to reach out, guys. I would love to hear the feedback on the session and the exams as well. All good feedback, I hope. And hopefully we'll cross paths and maybe we can say hi and a hello. Right. So until next time, hopefully take care and have a good one and all the very best with exams.
Thank you very much, Usama.
Thank you. Thanks so much.
Oh, welcome everyone.
Thank you.
Thank you. Thank you.